Interpolation of bond values. Suppose you got a $1,000 bond. Par value means it's just a $1,000 bond. It's redeemable at par, meaning, remember, at the end of the term, you get that same amount of money back, that $1,000. Now, before we go further, remember, this doesn't mean the price of the bond is $1,000. This is an investment. So you would think that if you're getting $1,000 at the end, you're going to pay less than $1,000 at the beginning. And that is often true. Not always, though. Sometimes you actually pay more than the par value at the beginning. Why would anybody do such a thing? It's because you get these coupons, right, along the way. We're having 4 periods. For the sake of simplicity, we'll assume those periods are yearly, though I didn't say that here. Though in reality, bonds are often paid coupons semi-annually, twice a year. But in your mind, maybe just imagine this is yearly. It's got a periodic, say yearly coupon rate of 0.06 and a yield rate of 8%. Before, when we did bonds, I did not tell you the yield rate. The problems we had before, you were trying to solve the yield rate. The application was solving equations using, for example, the bisection method or Newton's method to solve for the unknown yield rate. But now I'm telling you what the yield rate is. Okay. What happens in reality, in real life with bonds? In real life, you do have to solve for the yield rate because usually in real life, they just quote a price. Maybe this $1,000 bond, the price is $920, and you get a certain coupons based on a certain coupon rate, and you got to figure out the yield rate. Though that doesn't mean you have to figure it out. It just means somebody does, and they have to advertise what the yield rate is. Maybe you pay more than $1,000. Why would you do that? Maybe because the coupons are bigger. Maybe you'd pay more than $1,000 because the coupons are bigger, which means, though, the yield rate could be smaller. And this is something that you'll read about if you ever read financial literature. The lower the price, the higher the yield, which makes intuitive sense. You're getting a better rate of return if your price is lower to begin with. But as far as the market goes, prices are determined by supply and demand. Did you know that? That's the same with stocks. It's all a pure supply and demand. It's all whatever people are willing to pay. Though at the same time, when corporations issue bonds, they are guessing that people will be willing to pay a certain price. And so they set a price or set a yield and price it based on that. Doesn't mean people will buy all the ones they're trying to sell them. Okay, question 1, what is the price of the bond at time t equals 0? Let me just summarize what this says. I'm not going to read every single thing it says here. The price is the present value of all the payments, all the coupons, and the final redemption amount at the end. Remember, the coupons here are determined from the coupon rate. F times R is the amount of the coupon. It's the face value or par value, $1,000, times 0.06. 6% is this periodic coupon rate. 1,000 times 6% is 60. So all those payments at time 1, 2, 3, and 4 are 60. So you have a bunch of 60 coefficients here. V is called the present value discount factor. It's 1 over 1 plus I, where I is the yield rate. We're discounting those amounts back to the present time 0. So we multiply by powers of V. The final amount at time 4 is not just the final coupon of 60, but also the redemption value of 1,000. So you have 1,060 there. And if you solve for V, you get about 0.9259, which ends up meaning the yield rate is, did I figure it out here? No, I guess I didn't figure it out. Well, I knew the yield rate. It was 8%. I figured that out. I used that here. So the V was known here. It was not solved for. It was 1 over 1 plus I. 1 over 0.08 because the yield rate is 8%. And that implies the price would be $933.76. Okay, I mean, 8% is a pretty high yield rate. So you would expect the price to be relatively low, lower than 1,000, say. If I used a really low yield rate, let me just use a low yield rate like 1%. Watch the price now, it's actually bigger than 1,000. That's a 1% yield rate, resulting in a price of almost $1,200. Here are new questions. Question 2, what is the price of the bond at time 1? Assuming the first coupon has been paid. What is the price of the bond at time 1? Immediately after the first coupon is paid. So let's draw the timeline again here, like we did a month or so ago. Four bond payments of 60 at time 1, time 2, time 3, and time 4. Those are the coupon payments. And the redemption payment also of 1,000 at time 4. The price at the present value of the entire bond is the price is 60V. This first payment of 60 at time 1 goes back in time by 1 year, so we multiply by V. The second payment at time 2 goes back 2 years, so you multiply by V squared. The third payment by 3 years, and the total fourth payment by 4 years, 4 periods. And you get that. But what about the value at time 1, right after that $60 payment is paid? Is that a present value? It is a present value if you're at time 1. That's the present value at time 0. It's the price at time 0. What's the price at time 1? It's the present value at time 1. You might say that's no longer the present. Well, yeah, it's not the present if you are at time 0, but if you're at time 1, where time 0 was 1 year ago, then it is a present value. And if it's after the first coupon has been paid, the present value would be the present value of the remaining payments. And the one at time 2 has to go back by 1 year to get to time 1. So it doesn't get multiplied by V squared, it gets multiplied by V. The one at time 3 has to go back by 2 squared, so it gets multiplied by 2 years, so it gets multiplied by V squared. And the total payment at time 4 has to go back by 3 years, so it gets multiplied by V cubed. Effectively, you ignore the first term of the previous sum, and you lower the powers of all the other ones by 1. Mathematically. What should this price be? Maybe you don't have much intuition about what it should be. We can compute it. It is $948.46. Using the same yield rate, 8%. So it's a little bit bigger than the previous one. The price has gone up a little bit. Meaning, if the current yield rate in the market is still 8% for these kinds of bonds, if you bought it at time 0 for $933 and however many cents, and you get the $60 coupon payment, right after you get that payment, you could resell it for $948.46. Now, would that really happen? Not necessarily, because market conditions change. Maybe yields for these kinds of bonds, in fact, what's going on right now in real life here in 2023? In real life, the Fed and the government has been raising interest rates. Should read about this in the news. Why? Because they're trying to slow down inflation. But it has caused problems. What kinds of problems? Well, one big problem in the news recently is SVB, Silicon Valley Bank. It defaulted. It was a bank rush like from the 1930s. People were trying to take their money out. Why did that happen? It's because, from what I've read, they invested the money that people deposited, and banks can do this, in a lot of long-term government bonds. from a year or 2 or 3 years ago that had low interest rates. And now the interest rates have gone up. So the prices, the market value of all those bonds has gone down. The investors wanted their deposits, they wanted some cash, so they had to raise some money by selling those bonds, but they had to sell them at a lower price. That's why they lost a bunch of money, and it added up to billions of dollars. And they couldn't pay all the people who were making a run in the bank, and that's why they defaulted. Now the government steps in, guarantees those deposits beyond the FDIC insured values, which I don't know what a good idea that is, right? The government is just getting their tentacles more involved in our lives because of all these decisions they make. It's all connected. Anyway, the point here is it doesn't mean you'd actually be able to sell it for that. Unless interest rates were basically the same. But this is still a good thing to know about, if nothing else than for the purposes of accounting. And it's also good to know about values in between coupon payments, say at half-year intervals or fourth-year intervals or whatever. And the way you do that is with interpolation. But before we get into that interpolation, you should realize it's mostly for accounting. It doesn't mean that's what's actually going to happen when you sell the bonds, because market conditions change. It's still an application. People still do accounting. They have to think about these things anyway, even though, because they don't know what market conditions are going to be. What's the price at time 2? Immediately after the second coupon payment is paid. P2 or PV sub 2. The plain P refers to the price. The PV refers to present value. That's the present value of those remaining payments, now pretending we are at time 2. The payment of 60 at time 3 has to go back by 1 year to time 2, so it gets multiplied by V. The payment of 1,060 at time 4 has to go back by 2 years, so it gets multiplied by V squared. Once again, it's like you take the previous sum, you delete the first term, and you lower the power of the V's in the other terms by 1. What kind of number is that? That's yet a bit bigger. Right? V is less than 1, so higher powers of V are smaller. I have fewer terms that I'm adding, but the V's are lower powers, and so they are bigger, and it's enough to make these numbers bigger. This is immediately after the coupons are paid. I could think about the price right before the coupons are paid as well. And if I did that, I would not delete the first term. But more conventionally, people imagine these things right after coupon payments are paid. It's like before you sell it, you might as well take in your coupon. That's the idea. At time 3, there's only one payment left, the 1,060 at time 4 that needs to go back by 1 year. 1,060 times V is 981.48. How about at time 4, immediately after the 4th coupon, but before the redemption value? Now, of course, you might get that in just one payment, 1,060. But for the sake of thinking about this kind of stuff, pretend the coupon is like 1 second before the redemption value. So in that half second in between, the value is 1,000. Like if you wanted to sell it in that half second to somebody, you'd sell it for 1,000 actually, no matter what the market conditions were, because you're only going to get 1,000 back. So, it's like $1,000 for $1,000. It doesn't accrue interest. So we got a sequence of values of these prices, these book values, they're called in accounting type terminology. If you read literature about this stuff, financial magazines, online sites, textbooks, the terminology is kind of all over the place. It's confusing. I kind of think it makes no sense to call these things book values because it is an accounting thing. Though sometimes they're actually called market prices, but that's misleading. I have found they're sometimes called market prices. I think that's kind of crazy. I will call them book values. But also I will call them, another common term is clean prices. If there are clean prices, does that mean there are dirty prices? Yes, it does. What is our goal now? Our goal is to come up with reasonable ways to interpret clean price values or book values between coupon payments. If payments were every year, half years or quarter years or 1 month or whatever, can we do some accounting effectively in between? Yes, and it's interpolation, but it's not the same kind of interpolation we were doing earlier today. I'm not going to do Lagrange polynomials. It's formulas. Not just informing you about, for the purposes of just informing you about some applications of interpolation. There's 3 methods. Method 1 is called the theoretical method. We only got 5 minutes left or so. I'm just going to summarize these. Probably not assign homework today on this. Method 1 is called the theoretical method. Method 2 is called the semi-theoretical method. And method 3 is called the practical method. Those names are a little arbitrary. Let K represent the fraction of a period. Maybe I will assign it. I don't remember what I did. Problems. I don't remember what I've done in the past. So I probably shouldn't have said I won't assign it. Problems. But you just use these formulas. Okay. Let K be the fraction of a period between an arbitrary time t and a time t plus 1. So K is a decimal between 0 and 1. If the coupon payments are every year, to keep things simple, K would be a fraction of a year. K is 0.5, it's half a year. 0.25 is a quarter of a year, 3 months. 1/12 would be a month. Keep it simple, pretend they're all the same number of days. P sub t plus K is the notation for the price at time t plus K. So for after the price, say at time 2.25, it's t plus K that equals 2.25. T would be 2, K would be 0.25. The formula says do this for the theoretical method. The clean price, the accounting thing you put in your books, is this expression, which is called the dirty price, minus this expression, which is called the accrued coupon. Where do these formulas come from? The dirty price formula is a little easier to understand. Take the price at time t and effectively use compound interest to let it consider its future value k years later. K is 0.5, that's a half a year later. You're multiplying by 1 plus I to the k. That's like compound interest. This one's a little weird. F times R, that's the coupon amount. We're multiplying by that crazy thing. What is that? That effectively is compound interest, a compound interest factor, you might call it, that grows exponentially. Think of K as the variable. 1 plus I to the K would be exponential growth. And also is shifted down and stretched in such a way that it equals 0 when K is 0 and 1 when K is 1. Say that again. FR is the coupon amount. This essentially is a compound interest kind of growth factor that equals 0 when K is 0 and 1 when K is 1. Plug in K equals 0. 1 plus I to 0 is 1. 1 minus 1 is 0. Plug in K equals 1. 1 plus I to the first is 1 plus I. Minus 1 is I. And I divided by I is 1. So it's an exponential growth kind of factor That's 0 when I is 0 and 1 when k is 0 and 1 when k is 1, meaning product FR times that is 0 when k is 0 and F times R when k is 1. So it's like the coupon is growing. Why are we doing this? Because you want to think about selling before, if you wanted to think about selling halfway through a year, before you get that next coupon, the dirty price is actually more accurate as to what you might get. But again, I mean, it's affected by the market still. You're subtracting off the accrued coupon for the purposes of thinking about the clean price, where you're kind of not thinking about the coupons is the idea. The graph of the clean price is a nice continuous curve. If you think about the dirty price, it goes up and then it has a jump discontinuity because of the coupons. It makes it more complicated, is the idea. Actually, yeah. The dirty price, yeah, it's a discontinuous function. That's maybe why it's called the dirty price. What's method 2? It's called the semi-theoretical method, which is the one that's currently standard. Its formula is this. Same dirty price formula, simpler accrued coupon price. It's probably the idea that this is standard is because the accrued coupon formula is just much simpler. That's a linear function of k. That's 0 when k is 0 and F times R times 1 when k is 1. Simpler formula. That's probably why it's standard. The final method is called the practical method. Its formula is this. It's not used, even though its formula, you might say, is simpler than the semi-theoretical method. The difference is the dirty price formula is simpler. It's not exponential growth, it's linear growth. So why is this one not used if it's the simplest one? I think probably because it's, you might say, a little less accurate, because in the dirty price, you're not thinking about compound interest. Now, again, these are all methods that are all mostly just related to accounting. Not really what goes on in the market necessarily, but that's still a useful thing. People still want to think about accounting for purposes of thinking about the future and planning, and also for tax purposes. So it's still worth thinking about. It's just a matter of using these formulas. And again, when you use them, if, for example, you want to find the price at time 2.25, you take the t to be 2 and the k to be 0.25. It's t plus k that would equal the entire time 2.25. The t is a whole number and the k is a decimal fraction between 0 and 1. Okay? Well, we will talk about this more on Thursday. Have a good day.